Hi, today we're going to talk about the Series A preferred stock term sheet for an emerging technology company. As there are many issues associated with a Series A financing, we're going to break this video down into two parts. As a frame of reference, we're going to look at the National Venture Capital Association term sheet, or an NVCA, which is what the organization is sometimes referred to as. The NVCA documents are a well-known set of Series A financing documents that are available on the NVCA website. While the documents contain most of the key variations associated with a Series A financing, it's important to keep in mind that they are generally written from an investor perspective. So while they can be a great reference and helpful tool to understand the variations in a Series A financing, the terms are generally fairly investor-friendly. The first page of the NVCA term sheet contains deal-specific information, such as the closing date, who the lead investors are, the amount raised, per share pricing, and it goes on to talk about the pre-money valuation as well as the capitalization of the company on a pre- and post-offering basis. The second page gets into the alternative structures with regard to dividends. Dividends are amounts that accrue or are paid by the corporation to the applicable stockholders. The first alternative dividend structure is to have dividends payable only when paid on an as-converted basis when and if paid to the common stock. The key provision is when and if paid to the common stock. This is the most common structure in a Series A financing. The second alternative is to have dividends accrue and accumulate at a set percentage on an annual basis. The impact of including a provision like this in an early stage round of financing can be significant, as later rounds will likely have very similar or more aggressive provisions than the Series A. Based on industry statistics, in our experience, it's fairly uncommon to see this kind of structure in a Series A financing. The third alternative is to have non-cumulative dividends that are paid when and if declared by the board of directors. In early rounds, such as the Series A, when the board is not controlled by the investor, this provision is rather innocuous. In later rounds, however, when the company is generating cash and the board is controlled by the investors, this provision can on occasion become more operative. While these three alternatives are the most common dividend structures that we see in early stage financings, there can be alternatives or variations of these. For example, there can be an accruing dividend that begins after a certain number of years following the initial sale of the Series A. Also, as noted in the footnote in the NVCA documents, occasionally one sees a payment in kind or a PIK dividend structure in lieu of cash payment obligation. The next key provision is the liquidation preference. The liquidation preference refers to the rights that the preferred stockholders have to the assets of the company over holders of the common in the event of the sale or dissolution of the company. The NVCA term sheet outlines three alternatives. The first alternative included in the term sheet is referred to as non-participating preferred. The way it works is that if the company is liquidated, the preferred stock gets up to the amount of the investment back prior to any distribution being made to the holders of the common. The second alternative is referred to as participating preferred stock. Participating preferred stock entitles the holder not only to the holder's stated liquidation preference, but also allows the holder to participate in the liquidating distributions to holders of common stock after the initial liquidation preference is distributed to the preferred. The third alternative is referred to as participating preferred with the cap. As the name suggests, it's the same as participating preferred, but the upside is capped at a certain multiple, such as 3x or 5x return. While these three alternatives are the most common liquidation preferences structures that we see in early stage financings, like with dividends, there can be alternative or variations. For example, there can be a 2x liquidation preference entitling the holders of preferred to 2 times their original investment prior to the common stock receiving anything in connection with the sale or liquidation of the company. This is fairly uncommon, though, in early stage financings. As the liquidation preferences are relatively complicated, we have a separate video that goes through some of the details and basic financial modeling associated with those liquidation preferences. The next key term involves special voting rights. The first provision gets to designating directors. Usually, control of the board of directors is not shifted to the investors as part of the Series A. However, holders of the Series A typically get to designate one or more directors to the company's board of directors. Another set of special rights is referred to as the protective provisions. These are designed to give special veto rights to the preferred stockholders over certain company actions. The provisions in the NVCA documents are very generous to the investors. We typically advise our clients to weigh these veto rights very carefully and consider the long-term impact of actually having them as part of the company charter documents. So what are the takeaways from this part one of the key terms of the Series A term sheet for the emerging technology company? One, the NVCA documents are a great resource for understanding the Series A financing, but they are fairly investor friendly. Two, typical dividend provision alternatives include A, if and when paid to the common stock, which is the one most frequently used, B, accruing and cumulative, and C, if and when declared by the board. The third takeaway is liquidation preference alternatives include A, non-participating preferred, which is the one most frequently used, B, participating preferred, and C, participating preferred with a cap. The fourth takeaway is preferred stock typically includes special voting rights, such as the ability to designate one or more members to the company's board of directors. I hope that you have found this overview to be helpful. If you have any comments, let us know. Thanks.